Something extraordinary just happened in the silver market. And if you missed it, you need to understand what it means for the next 12 months. Because while everyone's been watching gold break records, silver just did something it hasn't done in over 4 decades. And the implications are staggering. Let me show you what I'm talking about. Silver just crossed $64 per ounce. That's not just a new high. That's a signal. A signal that the market structure underneath this metal has fundamentally changed. And here's what makes this different from every other rally we've seen. This time, the deficit is real. For 5 consecutive years now, the world has consumed more silver than it's produced. 5 years. That's not a blip. That's not a temporary shortage. That's a structural imbalance that's getting worse, not better. Let me put this in perspective. The Silver Institute just released their latest data, and global demand is running at 1.12 billion ounces. Production? Nowhere close. We're talking about a deficit that's been compounding year after year, draining above-ground inventories at a pace that would have been unthinkable a decade ago. And here's where it gets interesting, because unlike gold, which sits in vaults doing nothing, silver gets consumed. It gets used up, destroyed, gone forever. Think about that for a second. Every solar panel installed on a rooftop contains silver. Every electric vehicle rolling off the assembly line contains silver. Every 5G tower, every smartphone, every medical device. Silver. And once it's in there, it's not coming back out. The economics of recycling it from these applications don't work. It's too dispersed, too expensive to recover. So what happens when you have 5 years of deficits, with industrial demand that's not slowing down, and a price that's finally starting to reflect reality? You get what we're seeing right now. A market that's waking up to the fact that silver might be the most undervalued strategic metal on the planet. But here's what most people don't understand. This isn't just about supply and demand fundamentals. This is about a complete restructuring of how silver is valued in the global economy. Let me explain what I mean. For decades, silver has been suppressed. I'm not talking conspiracy theories here. I'm talking about documented market mechanics. The paper silver market, the futures contracts, the derivatives. They've created a pricing mechanism that's completely disconnected from physical reality. You can trade 100 times more silver on paper than actually exists in deliverable form. Think about that. The COMEX, the London Bullion Market, they're trading contracts for silver that doesn't exist. And as long as nobody asks for delivery, the game continues. But something's changing. The physical market is starting to assert itself. And when physical demand overwhelms paper manipulation, prices don't just rise, they explode. We saw this in 1980 when silver hit $50. We saw it again in 2011 when it touched $49. But both times the market structure wasn't ready. The industrial demand wasn't there. The supply deficits weren't structural. This time is different. The solar industry alone is projected to consume over 200 million ounces of silver annually within the next few years. That's nearly 20% of total global production. Just one industry, and it's growing exponentially as countries race to meet climate targets and energy independence goals. Then you have electric vehicles. Each EV uses roughly twice as much silver as a traditional car. And we're not talking about a few thousand vehicles. We're talking about millions, tens of millions. The entire automotive industry is electrifying, and every single vehicle needs silver. Add to that 5G infrastructure. The rollout of 5G networks requires massive amounts of silver for the electronics and connectivity hardware. We're talking about a complete overhaul of telecommunications infrastructure globally. That's not a one-year project. That's a decade-long build-out that's just getting started. And here's the kicker. None of these industries can substitute away from silver. They've tried. Believe me. When silver was $15, $20, $25 an ounce, every engineer in every industry was looking for alternatives. And they couldn't find them. Silver's unique properties, its conductivity, its reflectivity, its antibacterial characteristics, they're irreplaceable in these applications. So you have inelastic demand meeting constrained supply. And the gap is widening. But let's talk about the supply side for a minute, because this is where the story gets really interesting. Silver production isn't like oil or copper where you can just drill more wells or open more mines when prices rise. Most silver, about 70%, comes as a byproduct of mining other metals: zinc, lead, copper, gold. The miners aren't digging for silver. They're digging for something else, and silver just happens to come along. What does that mean? It means that even with silver at $64, you're not going to see a massive surge in new supply, because the economics of those base metal mines are driven by the primary metal, not the silver byproduct. A zinc miner doesn't open a new mine because silver went up. They open it because zinc economics work. And primary silver mines? There aren't many of them. And the ones that exist are facing the same challenges every mining operation faces. Rising costs, permitting delays, declining ore grades, geopolitical risks. It takes 7 to 10 years to bring a new mine online. 7 to 10 years. By the time new supply could hit the market, we'll be in a completely different price environment. Meanwhile, above-ground inventories are being drained. The COMEX warehouses, which held over 400 million ounces a few years ago, have seen significant drawdowns. The London vaults, same story. Physical silver is moving from west to east, from exchanges to private hands, from available supply to locked-up holdings. And here's something most people don't realize. Central banks are starting to pay attention to silver again. Not in the same way they buy gold, but they're watching. Because silver has something gold doesn't have. Industrial utility. Strategic importance. In a world that's electrifying everything, that's building out renewable energy infrastructure, that's racing toward technological advancement, silver isn't just a monetary metal anymore. It's a strategic resource. And countries are starting to treat it that way. China understands this. They've been accumulating silver for years. Not through official central bank purchases, but through state-owned enterprises, through import quotas, through strategic stockpiling. They're not stupid. They see the same supply-demand dynamics everyone else sees, and they're positioning accordingly. India, the world's largest consumer of physical silver, continues to import massive quantities, not for investment, for cultural reasons, for jewelry, for religious purposes. That demand is constant, unwavering, regardless of price. It's embedded in the culture, and it's not going away. Now, let me address something important here. Because if you're sitting on retirement savings, if you have $100,000 or more in traditional accounts, you need to understand how silver fits into a wealth preservation strategy. I put together a comprehensive guide on gold IRAs and how they work. It's completely free, links in the description. It covers how you can get physical precious metals into your retirement account without triggering tax penalties, how the process works, what the costs are, everything you need to know. If you're thinking about diversifying your retirement holdings into hard assets, it's worth checking out. But back to where silver is headed. Because here's the thing. At $64, silver is expensive by recent standards. But by historical standards, by the standards of what's coming, it's still cheap. Let me show you why. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been a reliable indicator of relative value for centuries. Historically, that ratio has averaged around 15 to 1. Meaning 15 ounces of silver equals 1 ounce of gold. In recent decades, that ratio has been much higher, 60 to 1, 70 to 1, sometimes over 80 to 1. Right now, with gold over $2,600 and silver at $64, we're looking at roughly 40 to 1. If silver were to revert to its historical ratio, we're talking about $170 per ounce. If it went to the geological ratio, which is about 8 to 1 based on how much silver exists in the Earth's crust relative to gold, we're talking about $325 per ounce. Now, I'm not saying we're going to $325 silver tomorrow, but I am saying that the current price, even at record highs, doesn't reflect the fundamental reality of this market. And here's where the $200 prediction comes in. Multiple analysts, including some of the most respected names in precious metals, are now calling for $100 to $200 silver within the next few years. Not based on hype, based on math. If the supply deficit continues, if industrial demand keeps growing, if investment demand starts to catch up to what's happening in gold, the price has to go higher. It's not a question of if, it's a question of when and how fast. Let me walk you through a scenario. A realistic scenario based on current trends. Solar installations are projected to double over the next 5 years. That alone adds 100 million ounces of annual demand. Electric vehicle production is expected to triple. That's another 50 million ounces. 5G infrastructure build-out, medical applications, electronics all growing. Add another 50 million ounces. So we're looking at 200 million ounces of new industrial demand on top of existing consumption. Where's that silver going to come from? Not from new mines. We've established that. Not from recycling. The economics don't work for most applications. Not from above-ground inventories. They're already being drained. The only way the market balances is through price. Price has to rise high enough to either destroy demand which isn't happening because this demand is inelastic, or to incentivize enough new supply and recycling to meet consumption. And here's the thing about silver. When it moves fast. In 1979, silver went from $6 to $50 in less than a year. In 2010-2011, it went from $17 to $49 in less than a year. When the market realizes there's a shortage, when investment demand kicks in on top of industrial demand, the price doesn't climb. It rockets. And we're seeing the early signs of that now. The move from $50 to $64 happened quickly, faster than most people expected. And it's not done. Because here's what happens next. As silver breaks through psychological barriers, as it makes new highs, as the story gets out, investment demand accelerates. Retail investors start buying coins and bars. Institutions start allocating to silver ETFs. Momentum traders pile in. And suddenly, you have a feedback loop. Higher prices attract more buyers. More buyers push prices higher. And in a market that's already in deficit, that's already tight on physical supply, that feedback loop can get explosive. We saw this in 2020-2021 when retail investors discovered silver. The Reddit crowd, the Wall Street silver movement, they bought so much physical silver that premiums went through the roof. Dealers couldn't keep inventory. Mints were rationing production. And that was just retail demand. Imagine what happens when institutional money starts flowing in. And it will, because institutions are starting to understand what's happening. They're looking at the same data we're looking at. They're seeing the deficits, the industrial demand, the supply constraints, and they're starting to position. Silver ETFs have seen significant inflows recently, not at the levels we saw in 2020, but steady, consistent buying. That's institutional money, that's smart money, and when smart money moves early, it's usually a sign of what's coming. But here's the real catalyst, the thing that could push silver to $200 and beyond. Monetary policy. We're living in an era of unprecedented monetary expansion. Central banks have printed trillions. Government debt is at levels that would have been unthinkable a generation ago. And the only way out is more printing, more debt, more debasement. What does that mean for hard assets, for tangible stores of value, for metals that can't be printed? It means they go up. Not in real terms necessarily, but in nominal terms absolutely. Because the currency is being debased. The purchasing power of every dollar, every euro, every yen is being eroded. And people are starting to figure that out. Gold has already figured it out. Gold's been in a bull market for years, making new highs, reflecting the loss of confidence in fiat currencies. Silver is just starting to catch up. And when it does, when the monetary debasement trade fully kicks in for silver, we're not talking about $100 or $200. We're talking about multiples of that, because silver has something gold doesn't have. It has the industrial demand story on top of the monetary story. It's both a strategic resource and a monetary metal. And that dual demand dynamic is incredibly powerful. Think about what happened in the 1970s. Inflation was running hot, the dollar was losing value, and precious metals exploded. Gold went from $35 to $850. Silver went from $1.50 to $50. Those weren't small moves. Those were generational wealth transfers from paper assets to hard assets. Are we in a similar environment now? The parallels are striking. Massive government spending, central bank money printing, rising inflation, loss of confidence in institutions, geopolitical tensions, energy crises. It's all there. And this time, we have the added dimension of industrial demand that didn't exist in the 1970s. We didn't have solar panels. We didn't have electric vehicles. We didn't have 5G networks. The industrial use case for silver was a fraction of what it is today. So if silver went to $50 in the 1970s without the industrial demand story, where does it go now with it? That's the question analysts are asking. And the answers they're coming up with are staggering. Some are calling for $100, some are calling for $200, some are calling for even higher. And they're not fringe voices. These are serious analysts with decades of experience in commodity markets. Are they right? Time will tell. But the setup is there. The fundamentals are there. The catalysts are there. And here's the thing about silver. You don't need to catch the exact bottom or the exact top. You just need to be positioned before the move happens. Because when silver moves, it moves so fast that by the time you realize what's happening, you've missed most of it. The people who made life-changing money in silver in 1980 bought in the mid-1970s when nobody was paying attention. The people who made fortunes in 2011 bought in 2008, 2009 when the world was falling apart and silver was under $10. The opportunity isn't at the top. It's before the crowd arrives. It's when the fundamentals are screaming, but the price hasn't fully reflected them yet. And that's where we are now. The fundamentals are screaming. 5 years of deficits, record industrial demand, constrained supply, monetary debasement, geopolitical uncertainty. All the ingredients are there. But the crowd hasn't arrived yet. Silver is still underowned, still underappreciated, still trading at a fraction of its potential value relative to gold, relative to its industrial importance, relative to the monetary environment we're in. That won't last forever. At some point, the crowd will figure it out. The institutions will pile in. The momentum will build. And by then, the easy money will have been made. So what's the play here? For investors looking at silver, the question isn't whether to own it. The question is how much and in what form. Physical silver, coins and bars, gives you direct ownership. No counterparty risk, no paper promises, just metal you can hold. The downside is storage, security, and liquidity. But for long-term holders, for people who understand what's coming, physical makes sense. Silver ETFs give you exposure without the hassle of storage. You can buy and sell instantly. The downside is you don't own the metal. You own shares in a fund that owns the metal. And in a real crisis, in a scenario where everyone wants physical delivery, that distinction matters. Silver mining stocks give you leverage to the metal price. When silver goes up, miners go up more. But they also come with company-specific risks. Management, operations, geopolitics, all of it matters. You're not just betting on silver. You're betting on the company's ability to execute. Each approach has its place. Each has its pros and cons. The right mix depends on your situation, your risk tolerance, your time horizon. But the underlying thesis is the same. Silver is undervalued. Silver is in deficit. Silver is essential to the future economy. And silver is going higher. The only question is, how much higher and how fast? And based on what we're seeing, based on the fundamentals, based on the historical precedents, $200 silver isn't just possible. It's probable, not tomorrow, not next week, but over the next few years, as these trends play out, as the deficits compound, as investment demand catches up to reality, we're going to see prices that would have seemed impossible just a few years ago. And the people who position now, who understand what's happening before the crowd does, they're going to be the ones who benefit. Because that's how markets work. The early movers get rewarded, the crowd gets average returns, and the late arrivals get stuck holding the bag at the top. Where are we in that cycle? We're early. Not at the very beginning, but early enough that the big move is still ahead of us. Silver at $64 is expensive compared to where it was. But compared to where it's going, it's still a bargain. And that's the opportunity. That's what this secret event, this structural shift in the silver market is telling us. The game has changed. The old rules don't apply, and the next few years are going to be unlike anything we've seen in the silver market in decades. The question is, are you positioned for it?